You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Joe Vanazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
All right, everybody. That rockin' tune means it's time once again for a rockin' show. Yes, it's time for the option block, your bi-weekly source for all things options related. We do it daily. We do it minute by minute if we could, but we all got other things we have to do too. We can't be option blocking all day long, as much fun as it might be. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you guys know the drill, if you're listening via the network feed, well done. You've got the full kit and caboodle. If you don't know what I'm talking about, go wherever you listen to this fine show. Could be on our site, could be on iTunes, could be by our app, however you get it. And look for the full kit and caboodle, the full network feed. It gets you all the shows. I think it's somewhere around 15 that you can listen to. So if you're saying, my day is devoid of options content, I need more to fill this hole, we got you covered. We're hole fillers here. We can fill all your options holes with all the content you could possibly need, and probably a little more. So check that out wherever you go. And again, I mentioned our app. You can get it all there as well. Available in all the major app stores. You guys know the deal. And of course, fun little bonus for you hardcores, you crazies out there. You can join us every Monday and Thursday, 3 p.m. Central, 4 p.m. Eastern, via the live stream on the Mixler. You can listen, you can chat, you can ask questions, you can just have a good old time there. Again, Mixler, MIXLR. Stay tuned to our social media. We tweet out the link all the time. If you've seen it before, you got that link, set it and forget it, you're good to go. And however you listen, hit us up. Questions, comments, insights, pearls of wisdom. It may not sound like it, but we actually do like to hear from you guys. And joining me on the old program today, let's start off. Where shall we start today? Let's gaze our eye of Sauron out upon that metropolis, nay, the provincial hamlet known as St. Charles, Illinois, where we are joined by Uncle Mike Tosaw from RCM Wealth Advisors. Uncle Mike, welcome to the show. I can hear the birds singing in the background. Is it yet another beautiful day there in scenic and lovely St. Charles, where all is perfect in paradise on earth?
I don't see how life could possibly be any better. I struggle to see the thing.
Yes, I wonder sometimes as well, how could life get any better for you folks out there in St. Charles? I mean, you're close to, I think, one, if not two, Skippies, Gyros, and lemonade. So if you got that in your life, everything else is just gravy at that point. And also joining us from a place where I don't believe they have Skippies, Gyros, and lemonades. I don't know what they have out there. I guess they have LL Beans and lots of lobsters. That means we're joined by the rock lobster himself, Mr. Andrew G. from OptionPit.com. Mr. G, welcome back to the program. What else do you have out there besides lobsters and LL Bean?
What else do we have besides? We have whoopie pies. We have whoopie pies, and we have clams, and there's a baked bean factory outside of Portland.
A baked bean,
that helps.
A baked bean factory. Whoa. Yeah. Trying to steal some of Boston's thunders. Watch out, Boston there. Bostonians. Maine's coming at you. And you know what else is coming at you? Is the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody. Welcome to the Trading Block. This is indeed the portion of the program where we break down what the heck was happening today, what was moving, what was shaking, what was rocking, what was rolling in today's market activity. We are recording this and indeed streaming it live out here, 3 p.m. Central, right around September 14th. For all of you playing along on the old home game. And after some turbulent markets over the last couple of weeks, these last few sessions today in particular, a little bit of a breather, a little bit of a respite, not a heck of a lot, really lighten up the old major indices, at least today. S&P had, looks like about 7 handle range out there on the day, closing effectively unched, slightly off, but nothing really to write home about. And most of the other, actually, the tech-heavy NASDAQ, off a wee bit more, off about 0.5%. And Dow bucking the trend. Dow, one of the few sites of green on the screen, up about nearly 0.25 percentage point. And of course, all this hither and yon means the VIX doing a little bit of its own hither and yon, kind of unched on the day as well. Still hovering, still flirting. Will it go south to the single digits? Will it go north into become a tweener again, right around 10.5? So it can't make up its mind. Doesn't want to be a tweener. Doesn't want to be a single digiter. We all have those problems in life. VIX is confused as well these days. Let's see if we can make sense of it. Let's start in reverse order. Let's go the other way around the horn. Let's go to I almost called him the meatball, the rock lobster. Mr. G, what's cooking? Oh, before we even get to that, before we lighten up your tape, I should mention I just came from an event. I spent most of the day over at the CTA Expo, an event here in Chicago. It goes around the country, but it comes to Chicago every year as well. A place where you sit down and talk with a lot of CTAs. A lot of CTAs show their wares, see what they're doing over there. In the previous years, it's been commodity trading advisors, what you would expect. A lot of ags, a lot of energy, maybe some metals, and a few S&P futures guys in there. This year, it seemed like it was vol. Vol was the place to be. A lot of people pitching their vol wares. In fact, Mr. Rock Lobster, I thought of you when I heard this. Someone was pitching to me today a strategy of, I think, 40 to 60 day iron condors in VIX options. And it just struck me as interesting for a couple of reasons. First off, I can't remember the last time someone's pitched me an iron condor strategy. It seems like that strategy, after having been just the bee's knees a few years ago, about 4 or 5 years ago, you couldn't get people to shut up about iron condors. Now it seems like nobody's talking about them anymore. And being VIX, those seem like a weird, odd duck. I think he wanted 10% out of the money. I thought it was an interesting choice. So first off, does that surprise you? People are out there pitching, trying to get 2 and 20 to do 10% out of the money VIX iron condors. And then B, what the heck else is catching your eye?
I don't think it surprised you because, it really is a pretty good sale, although I like the call side. I don't like the put side very much. But I can see where that is a strategy. It can be a strategy sometimes, for sure. So I mean, it's just those times in VIX where things get a little bit woolly and scary. As far as what's going on right now, VIX, from a cash point of view, we don't have any movement in the SPX. I think things have finally, they've calmed down for today. That's all I can say. VIX is back down to 10.5. I do not think we'll see the 9 handle for the rest of this year. It's possible, but I don't think so. It seems there was some more talk of Washington, D.C. getting things done yesterday. Right now, until earnings, I think kind of volatility in the market is slightly captive to the news out of Washington until there's bigger news, until there's earnings or something like that. So the daily whiffs and trends, the way the equity market works can be fleeting. So, but right now you'd say VIX is probably fairly priced at 10.5. The market's moving a little bit. It's just ran out of upside gas. We keep trying that 2,500 is so elusive. I think the SPY traded 250 and actually closed above 250. So it's a lot of, and I don't even think very long ago, January 2016, we were trading 1850 SPX, as I recall. So, it's like the same thing. You got to be a buyer when, and right now you're probably looking for stuff to get rid of. So as far as all that goes, some of the interest rate stuff that we saw, I don't know if that's really coming to the fruition. The banks seem to have popped back. And it looks like, some kind of tax plan is on. Again, all the same kind of stuff that drew some help push bullishness and vol down. It seems to be back on the front pages again, and that helps vol lower. So one thing I will say, though, is we have, at least the way I look at VIX, you have pretty expensive future premium still with like a week to go or less than a week to go. The SEP 20 futures 1160, that's a full dollar over where it is right now. October's over 13. Both of those are slightly up today. So, there's a little worry. It's just what's happening is, I think the futures are definitely short term, are expecting a little bit more of a pop in VIX. They're not buying this sort of quietness, not with that much premium in the future. So we'll see if those future traders are correct or not. And that's kind of where we are. So there's still a little bit of nervous in here. Personally, I like put spread or put time spreads. We'll be doing a webinar tonight, and I'll be talking about those for Delta. I think they're very inexpensive at this point. So especially in the SPX. So that kind of jives well with, get the higher future, a little bit of nervousness. Vol is cheap, so you buy some time spreads, put time spreads a little out of the money, and you can kind of create a little mix of a trade that way. And that's what we have. Tech, all that stuff. Tech is weak, and I think that's kind of helping the futures. As you recall, Qs are down almost 1% today. I'm sorry, a little over 0.5%, which... is down 1 point or almost a little more than 0.5%. So that always makes people nervous. And I think that's what we have. We have a mixed bag. And if anything, you have SPX down, VIX down, which is usually bullish. That's just that's a big sigh of relief coming out of the market.
So what you're telling us then is as soon as we get off the show, you're about to go out and start hawking a fund for 10% out of the money iron condors. That's what you're telling me in VIX?
Well, we already have a fund that does VIX.
Specifically only for 10% out of the money iron. That's all you can do.
No.
40 to 60 day, 10% out of the money iron condors. That's all you can do. That's it.
No, we do not do that fund.
Oh, well, shucks. You're not there then today. You're not there at the Fund Palooza. That was CTA Expo. Yes, people talking about slinging some of the futures term structure a little bit too. Maybe we'll get a little bit more into that on vol views tomorrow. But it struck me as interesting that an event like CTA Expo, which has traditionally been dominated by things you would assume, the commodities and things like that, that all of a sudden vol beginning to rear its ugly head. And the question everyone kept asking these managers, what I thought was kind of funny in their quote Shark Tank type events, was how are you making money when there's no vol? It was kind of funny. So that message has resonated even to audiences that don't maybe particularly play in those markets. Uncle Mike, same question for you. By the way, Uncle Mike, I have something for you as well before you get going. I kind of flipped the script on you today. It's Thursday. It's mail block time. So usually this is the time of the week where you just kind of pick something and we talk about it in the education segment that's known as the strategy block. I said mail block, I meant strategy block. But today I thought I'd flip the script on you. So I started the show right before we started, just went live a little bit ago. So people have a quick amount of time if they haven't voted here yet. But head on over there at options. I asked you guys, what do you want Uncle Mike to explain to us today? Let's put Uncle Mike, put him on his heels a little bit. So we're going to give you 4 choices. Rolling covered calls, choosing a covered call strike, rolling protective puts, or paying for protective puts. It just went live, Uncle Mike, so the votes are still starting to trickle in. But what would you think of those 4 is winning so far, Uncle Mike?
I would say paying for protective puts.
That's what I thought, too. I thought that would be a home run. Everyone would want that one. No, so far 2/3 saying choosing a covered call strike.
Ooh,
interesting.
That's a fun one.
So I'm throwing you a little bit of a curveball. I'll keep an eye on these numbers as they come in, and then maybe right before the strategy block, I'll toss it to you, and you'll have to just kind of do it on the fly. How's that sound?
Perfect.
All right, I've held you up enough. I know you want to hold court at length on the metals and crude and XLE 30 puts and everything else. What else you got, sir?
Well, strike prices people want, strike prices people will get, assuming that's what the vote is come time. It's ironic. I wrote an article on strike price selection. Oh gosh, probably like maybe 12 years ago, I think, and that's kind of what put me on the map in this business, and that's what got me my book deal, and that's what basically changed my whole career, was with some article on strike price selection. So this will be reminiscent today, if indeed that's what it is. But if not, I will do my best to be a professional and explain whatever it is. And in terms of I was thinking on volatility, someone selling iron condors on the VIX. I always like it's something else to where only in America can you have a CTA that makes that earns its living selling volatility on volatility. And it's a really kind of a cool concept when you think about it. Only in America. But anyway, just to add to what you were saying, crude, oh my gosh, how can you not want to talk about crude today? It's up 10% over the course of the last couple of weeks. I know we had talked about on TWIFO a couple of weeks ago, right before the storms had hit Houston. The crude did not come up too quickly right away, but since it has. So we do have crude. It actually crossed the 50 mark today. That's kind of one to where it's had a hard time going above and staying above, but I still think it's towards the lower end of its range from a long-term standpoint. In regard to XLE, that's back from the dead, so to speak. And for those of you that have been holding it, you've been enjoying a nice little dividend on it the last couple of years. And it even hasn't moved much, but you've had a holding, and you've had some money coming into your pocket, which is not exactly a bad thing. I don't want to say my trademark saying until the S&P crosses 2,500. It just doesn't feel like a new all-time high yet until we get through that big number. So I'm going to save my trademark saying for that. But a couple other things that I thought were kind of interesting. The healthcare sector, XLV was relatively flat on the day, like everything else, but we did have gains in Merck. Now, this is something that I don't think it's going to pass, but I do think it's going to make a lot of news, and I do think this is going to be another macro event we're going to be talking about over the next couple of weeks. The latest thing to take a look at, and that is Senator Sanders wants to pass Medicare for all, and it looks like it's actually going to get a vote on the Senate floor. I don't think it's going to pass, and even if it did pass, I would be pretty confident it would get vetoed with the current president. But I do think this is going to get a lot of people talking about where things can go in the healthcare sector, whether it's with health insurance companies, whether it's with pharmaceuticals, just pretty much everything into that sector. So if you think that the healthcare debate has calmed down, and it's not going to be in the news a lot, I think this is going to bring it back in the news, and I think it's going to be another thing that we're going to be looking at, whatever side of the fence you may fall upon, in the next few weeks. In terms of macro events, I think, like Andrew said, the market is it's calmed down for now, and but we have a lot of irons in the fire that could make it not be calm in the relatively near future. And that's my take on what we actually had today. Oh yeah, and Apple announced a new iPhone that people may or may not be willing to pay $1,000 for.
Yeah, I figured you had to rope Apple in there somewhere. You are our resident, not so much anymore, but you were our resident Apple devotee there for all things iPhone, iPad, watch, etc. I was kind of surprised yesterday we saw people actually pumping up the stock a little bit. Usually it's the old buy the rumor, sell the fact, and we're seeing a little bit of sell-in today. Apple off, about nearly 1% out there. But still, not as much of an aggressive move in either direction. This name still hovering right around 158 and a quarter or so. So still fairly rich. And speaking of rich, you got to be pretty rich to buy that new iPhone 10. Pretty pricey. There were rumors for a while it was going to be north of $1,000. And quite frankly, you can get north of $1,000 with a lot of other smartphones out there these days as well. If you start adding up storage and everything on some of the previous iPhones, even get some of those Galaxy Note 8s and start juicing those up, those things will get north of $1,000 pretty quick. So it's not like that's unheralded territory in the smartphone space, but still, to be out of the gate, $999. That's a tough road to hoe. So we'll see how that does in the ever competitive smartphone landscape. Really quickly before we move out of the trading block, it's earnings season kind of in the rearview mirror for us now. Most of the big names have popped off at this point. I'm just kind of curious if either of you guys. I mean, I'm trying to think. To me, there wasn't really the huge standout moment we've seen in a lot of other cycles, or one big name really blew the doors off to the upside or to the downside. There was one kind of resounding narrative like we saw 2 cycles ago where pretty much almost everyone underperformed their straddle. We didn't really see a lot of that this time around. I'm kind of curious, maybe if anything in particular resonated with you. Maybe we'll start with you, Mr. Lobster, because you're in there with the crazies all day, pit-chatting away about all things earnings and what's going on. Anything in particular really resonating with your crew there this cycle, and are any events or names or trades that particularly stand out when you think about earnings this year?
Oh, I mean, for the entire year?
Just I meant for this past quarter, this past cycle.
Wow, earning. Geez, Louise. I'm trying to think, but maybe I think the biggest surprise might have been Apple, I guess. Well, of course it's Apple, so that's, it's the one everybody talks about. Also, we didn't get that big of a bang out of NVIDIA. It's selling off. I'm trying to think of anything that was really eventful, but I seem to kind of remember just overall for earnings, kind of the big meh for tech in general, because we had that huge run up in the Qs, and I think all the earnings weren't bad. They were pretty decent, but all the stocks had ran so far on expectations that I think there was a big woohoo, we're waiting for something huge, and then we didn't quite, we didn't quite get the move we were looking for. So I think as far as earnings go, that's the only thing that really sticks out in my mind on this cycle. I'm just going through the list here and thinking, I don't recall a lot of great, really cool things happening. So I think that was the biggest thing. Like the big Q stocks, none of them are near their, they're sort of around, but Amazon is still what, $90 or $80 below its all-time high. Google was $1,000 stock, Google L, and now it's $940, $930. So they're all just kind of sitting there. The only stock I think that is really making new highs or close to it is of all of them is Tesla.
So, go figure, Tesla.
I'm on my mind. I'm like, I'm starting to price a 400 fly right now, just because it's like, okay, clearly nobody gives a damn. So I want to see how cheap these things are on the upside. I
thought you were going to say you're pricing some 50 puts because you two are being drawn into the bandwagon that is the 50 put palooza.
Not quite. But yes, I think this one has the look of something that wants to trade $400, like Tosaw was waiting for $2,500 for the SPX. It's you're $23 away, and it was up $11 today on, I think there's going to be Tesla buses or something. I don't know what it was. But there's going to be Tesla everything. The world will be Tesla. So I think that's all hunky dory. But this is definitely the stock that has caught the Greens' attention. I don't think they even look at any other stock on the planet anymore. So this is it. This is the game, and right now people want it.
I don't know if you know, but every single Chinese person is about to buy a Tesla forthwith. So hence the stock up another $11.50 or 3% today. Madness unfolding out there. Uncle Mike, any particular madness? Otherwise, I'm kind of with you, Mr. Rocklops. It wasn't a season that really stood out to me, any market capacity. Uncle Mike, anything really resonating for you this past earnings calendar season here?
Well, Apple's one that we do have in our triple income portfolio, and that's one that oversimplified of what we had done for this past cycle, or the cycle when it was in earnings for our monthly covered call, was we looked at the straddle and we just sold the covered call basically right at the edge of the straddle, which was basically the 160. Not basically, it was the 160 call, and it was a little bit further out than further away from the price of the underlying than what we had been doing, but we wanted to stick to our rules with that, and that was one that Apple did have the nice move after it, but it was still within where the straddle was. Another one that we were in that it didn't really move a lot, but it definitely has kind of caught our eye from the channeling effect is Microsoft. We also have that one in our triple income strategy. That is one where we actually were short the 72 half puts. We got put to us and it's just been cycling or channeling, I guess I should say. Their earnings I'm showing July 20th, and they were at 74.20. They went down. It went up. It went down. It went up. It's just continually seeing this channeling effect. And once we got in, we were able to, after the earnings, of course, sell the 74 half call. And so we'll be looking to see where that ends tomorrow with that. So the one that struck us that actually moved was Apple, and the one that struck us that really didn't move was Microsoft. So those are kind of the first two that come to my head when talking about this past earnings season.
All right, and with that, let's keep on rolling. It's time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that funkiest of tunes means it's time for the funkiest of segments. It's time for us to put on our fedoras and perhaps our trench coats. Even though it's a little warm in here in the studio, so I may forego the trench coat today. You'll forgive me, listeners, as we head on over to the shadier side, seedier side of the options market. Time for the Odd Block. Let's kick things off. Where shall we start today? Let's kick things off. You know, I'm feeling a little transporty. Let's start off in Union Pacific Corp, ticker symbol UNP. Closing today, 110.86, up about 2%. Not a bad day for good old UNP. But actually, this paper, and in fact, all the paper we're going to talk about today, is kind of looking back at some highlights we made and some stuff we noted on our show all the way back in February, on February 13th. To be precise, we highlighted these three individual trades, and we like to look back every now and then. You guys are always asking us, what about this trade? What about that trade? How did that work out? So let's pull some, and let's see how they worked out. And back then, if you remember, our listeners from February, who doesn't remember our February 13th show? An epic show that it was. We started off talking about paper loving themselves. Some Jan 2018 130, 150 call spreads going up for $2.22. Paper buying nearly 10,000. A lot was going up that day. But there was tons of OI on that strike too. People were piling in. It was more and more piling in. People were just liking themselves that vertical. At the time, the stock was right around 108.5, which is actually about $2 lower than where it is right now. Yesterday it was right around that level. Now it's a little bit higher. But as you can see, the magic and mystery that is time decay has not been our friend's friend. And by the way, the strike opened about 140,000 open on both of these strikes. So it seems like this spread is still open and done so for size. And this spread now looking too good. Like we said, our friend put it up for $2.22 back about 6 odd months ago or so. Actually about 7 now. And so far those 7 months have been costly to the tune of this spread is looking right about, looks like about 35-cent bid right now. So if you wanted to get out of this bad boy, he might be wearing it. Let's see how this thing has performed over the past few months. It's kind of been right about at these levels. It got a little bit higher after he put it on back in February. It dipped a bit back in February. Got down to 102, so it wasn't looking too good. Then it rallied back in late April, up to about 114 almost. So he was probably happy at that point, smiling then. And then it's kind of just vacillated ever since. And we all know when you're long premium, the one thing you don't really want is vacillation, unless you're aggressively gamma scalping. Maybe our friend was doing that, but these 130s probably not giving him a lot of juice to do that with. So I don't know, Mr. Rocklops, at least so far, of the first of our three we're going to look at, so far it seems like we got a swing and a miss. What say you here? Oh, I see you're using the technical term for this, poop sandwich. Is that what you think of this trade? Is it indeed a poop sandwich, sir? That is a term of endearment at Option Pit for a trade that just it's gone south. So it does indeed look like a poop sandwich. It's just there's no, it might do something, but why you would buy a call spread on railroad stock is totally beyond me. But what the heck do I know? That was $30 out of the money at the time. So I wish them luck. I hope they make lots of money and Union Pacific becomes a behemoth. But
it already is a behemoth in a way, but I don't know if it's going to be a behemoth to the 130 strike.
This guy needs it to be a behemoth, and he needs it to start happening now. Because this thing so far not looking too good, and he's wearing it because still a bunch open. So yeah, technically a poop sandwich, says the Rock Lobster here. I love the technical terms you guys throw around over there at Option Pit. You know, you really capture the nuance of the situation. Okay, so far, one bad one, swing and a miss here. Like we say, you know, size money, not always the smart money. If there's one lesson to take away from all of our odd block segments, that is the lesson. So bear that in mind. Let's see if we can, but we don't root against our fellows. We want people to succeed. Let's see if we can get a better result here for our friend in number 2 on that show. We profiled a paper coming in, overwriting, looks like selling some calls in True Car Inc., ticker symbol True, TRUE. They were selling them for, these are the April 12 halves. So they expired back in April. For $1.25. It did it nearly 10,000 times. Of course, there was about 100,000 total had traded in a couple of days on that strike. So those Aprils were pretty aggressive. Someone was pretty aggressive and overriding. It had to feel like it was a bit of an underlying holder, perhaps getting a little bit of premium. Back then, these calls were actually in the money, which was kind of interesting. The stock was about $13.20 when he overwrote these. So they had about 70 cents a juice. He was doing it in February. He was getting another 2 months for about 50 odd cents there of extrinsic value there on those calls. And so we went and looked it up, and this stock actually closed at 15 and a quarter or so, right around on expiration in April. So it looks like our friend may have been a wee bit aggressive on that strike. Obviously, if he was net shorting those out of the gate, then he was not looking too good. And if he was doing covered calls, then he may later want to listen to Uncle Mike's seminar on rolling, if that is indeed what he chooses to do, or what our audience chooses for him to do. I don't know. Mr. Rock Lobster, what say you here? Are you going? Let's look at the chart here before we get into that really quick. And the past 6 months or so out here in True, since our friend put this on in late February, this thing is pretty much has never looked back. It's kind of been north of that 12.5 level pretty much ever since. He sold them for $1.25, so he needs it to be obviously $13.75 is his upside, and he's pretty much been north of that pretty much the entire time. It got as high as 21.5. So our friend here may have been regretting his choice of thing. But of course, if he rolled or if he had the underlying and he got called away either way, maybe if he reestablished, he could be happy. Mr. Rock Lobster, what say you here? Probably less of a poop sandwich on this one, because at the end of the day, he still got called out at a higher level if he had the stock, so he's probably not super sad. But there's also the missing out of many handles since then. So how would you categorize this one? Poop sandwich, poop fajita, somewhere in between? What is it?
A poop fajita. See, I wouldn't even think poop fajita.
See, that's why I get the big bucks, sir.
Well, how do you top that? How do you top a poop fajita? I don't know. But anyway, this is one where I think it was a long call holder. I remember this customer single-handedly crushed the volatility to nothing, selling these options. And I would only assume they were writing it against stock, because the stock was in the single digits at the beginning of, toward the end of 2016. And by the time they were lifted on this thing, it was trading 15.5 or whatever. So I would only assume they bought the stock for a little bit and they just decided this was where we're going to get out. And I can only assume they were signed on everything. But I remember this as a back spread. You could buy these things. They got down to like 30 cents over parity with like 2 months to go. I mean, it was ridiculous how cheap they were. So if you were a buyer of these calls when this guy just killed the vol, you did quite well for yourself. So I'm just assuming this customer made money probably from from the single digits all the way up and just took their money. So, but other than that, if you don't have a strategy when you're that aggressive selling calls, you will lose your stock. So I'm going to assume that they lost their stock, and that still would be a good trade.
Yeah, no, not terrible. He still made money, but I'm sure these things almost were instantly in his face the second he wrote them, like a few days later. So he probably was maybe regretting his aggressive choice of strike selection. Perhaps another thing Uncle Mike could talk about. I'll give you a breakdown how it's shaping up right now, Uncle Mike. Live voting. We got a tie now. 40% for choosing covered call strike, 40% for rolling protective puts, and 20% for rolling covered calls. No joy, no love for paying for protected put. I think something must be wrong with Twitter. Who's not voting for that one? So that's what we got so far, Uncle Mike.
Wow.
So you're prepared. Coming up in a few minutes, we'll toss to you, see what exactly. If it's a tie, I guess you get dealer's choice. So we'll see. We need one more. If one more vote comes in there, you could tip it either way. Then Uncle Mike doesn't have to choose. But we shall see. All right, we got one more. They got time for one more here. Then we'll see how that vote is shaping up. Let's wrap it up. Another weird one that day back in February 13th to be precise. It was someone drawing a pretty big, kind of crazy line in the sand here in Amgen, ticker symbol AMGN. At the time, it was trading about 168. Today, closing 189.5, almost off about off fractionally on the day, but obviously well north of where it was trading back in February. And someone decided to put up one block of about 6,500, of the Amgen April, again, back to April, 115 puts, blasting those out for a whopping 4 cents. We don't usually like to see those, it's just, it's not too much reward for the risk you get. But of course, someone deciding, of course, they would like to buy the stock at that level. And it was 50 handles below where the stock was trading. So I guess it wasn't too much of a risk, but still interesting. Just a weird block, decent size for such a weird, less than a nickel trade. Again, someone just drawing a line in the sand, maybe an Uncle Mike wheel trade over there. Getting that 4 cents, and as we know, the stock pretty much never really looked back. I'm looking back here over the past 6 months, and this thing it's kind of just been kind of range bound, like 160 up to about where it is right now, about 189 or so, kind of in that range. Certainly never threatening the 115 handle. So it looks like our friend skipped home with about 26 grand or so in his pocket from these puts. So Uncle Mike, Mr. Rock Lobster. This one, I mean, I know it offends you from your risk parameter sensibility. You would never allow this to happen in your Iron Condor trading fund. But that said, looks like our friend got away with 26 grand. So I guess not quite a poop sandwich or a fajita, more of like a, let's say, maybe a tasty trifle. Like, let's say a nice gelato, maybe. What do you think?
Tasty gelato. The only thing I can say is how much margin did he tie up for the 4 cents? I don't even know how.
I would wager probably more than 26,000.
I don't know. Because it's at least down to $100, right? 50% of that. So that's not a small amount of margin, don't you think? So anyway, the only thing I can think of is somebody's just long the stock and they're bored. So they're going to sell some 4 cent puts. Hey. How some of these trades go up, it puzzled me when I was a floor trader, and it puzzles me still to this day. How the heck this stuff happens? Puzzling, but profitable.
He kind of covered his cost of carry for that period. So maybe instead of a whole bowl of tasty gelato, maybe like a sampler, a little sample of tasty gelato. So it wasn't
like one of those little tiny spoons.
Exactly, one of those little spoons of gelato. It wasn't quite poop in your face, but it wasn't a whole delicious, tasty treat either. So there you go, listeners. Size money, not always the well-timed or the smartest money. Just a little reminder. You guys are always asking us, so we thought we'd indulge you with a little trip down memory lane. In this case, all the way back to February and some odd block. Interesting. So we had one decent one and one really garbage one that's still hurting. And then one kind of did all right, but could have been a lot better. So there you go. That's our breakdown. Let's keep on rolling let's see what we're going to talk about for this Thursday's strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the Strategy Block.
All right, Uncle Mike, here it is, live voting as we speak, and it's still tied. So you get a reprieve today. You get to choose. You get your choice of either 40% for choosing covered call strike or 40% for rolling protective put. So which of those two would you like to pontificate on at length, sir, for today?
You know what? I'm going to do this. I'm actually going to leave it up to my co-hosts because I want this to be as random and as off the cuff as it can possibly be. So I'm going to leave it to my co-hosts to be the tiebreakers.
All right. I think you did covered call strikes kind of recently, so I'm going to guess rolling protective puts. That's what I'm going to go for. What do you say, Mr. Rock Lobster?
I'm gonna say rolling protective puts just because it feels like it's about that time for him to do that. Because market's up a lot. I feel like this is timely. That's why I'm going with that. I'm feeling timely on this one.
There you go. Uncle Mike asking, you shall receive hold court, sir, on rolling some protective puts.
All right, will do for sure. It's kind of ironic because in our hedged strategic night strategy, we're actually having a meeting tomorrow, and I'm presenting to our investor policy committee as to how we are going to roll our protective puts going into the next expiration cycle. So this will get me warmed up for my big meeting tomorrow. So anyway, with that, for rolling protective puts, at some point in time, you need to do something. So for example, let's say that you're long a stock and you're long a put, and let's just forget collars, let's forget spreads, let's forget everything for a second. Just take it back to the most simple level that we possibly can, and that's just being in a married put position. Well, at some point in time, if the stock increases, you want to protect your gains, roll the put higher, most likely, or just get out of it. And at some point, if the stock goes down in value, you want to take the profit to the downside put on this. Because if you just sit there and do absolutely nothing, you're in a position to where you are basically long a call and you have time value working against you in the same way, just not as leveraged because you have all that long stock. So let's take this for all three situations. What if the stock stays the same? What if the stock goes up? What if the stock goes down? Okay, let's start off. Let's have the good news. What if the stock goes higher? You buy a stock, you're kind of concerned about it, you want to buy a married put on it. Stock goes higher in value. Well, if the stock goes up, let's say the stock's trading at $75 per share, and you buy the 70 put on it. For whatever reason, that's the one you decide. And the stock goes up to $75.50. Woohoo! We made a little bit of a profit. I am excited about it. Is that the time to roll up the put? Good gosh, no. Unless for some odd reason the vol on the 75 put is royally crushed that day, and the vol on the 70 put that you have went higher for whatever reason. That would be the only time that you would do it on that small of a move. Typically, when I like to look at rolling up puts, if I'm in a married put position, I want to go up usually 2 strike prices. So in other words, if the stock's at 75 and it has $5 strike price increments, that's kind of what I'll look at in a stock that priced. If it were to go to around the 85 level, that's likely when I would start to roll the put more. And the reason is you have to have some type of a balance between when you're going to do it. Because if you wait too long, I'm waiting until this thing goes to 100 and the stock's at 90. And then all of a sudden the stock goes right back down to 75. Well, you're going to be kind of upset with yourself that you waited so long. But if you roll it when it's at $75.30, I'm protecting every penny, by gosh. That's one extreme the other way. So I think that you need to have some type of a happy medium, depending on where you think the stock's going to go and what your sentiment is and what your time frame is. But usually, I would say 2 strike prices is about where I like to do it at personally. Sometimes 1 strike price, but if I'm looking to protect it that much, then I would likely just look to maybe finance it to where I would sell a covered call against it or something like that. But in a married put only position, I would say roughly 2 strike prices. Next section, what if the stock doesn't move? You're in this protective put position, and good gosh, this stock's just not moving. This is just driving me insane. I have money coming out of my pocket every day because of time decay. I hear Mark Longo talking about Don Schlesinger saying you should only be selling options or not selling options, and it is just it's going against me every day. Every time the clock moves, every second I am losing money, and it is a stressful thing. Good gosh, when can I get out of it? Well, here's my general rule on when to get out of it or roll it out, so to speak. Number one, you still have to be bullish. If you're not still bullish on the stock, if you're like, well, this thing ain't moving, I'm getting out of it, well, then get out. Take your lumps and go. Don't try to be a revenge trader. Revenge trading is one of the worst things that you can ever do. Well, and what revenge trading is like, well, I'm in this deep. I got to at least make my money back on this trade. Don't do that. That's one of the dumbest things you can possibly do, quite honestly. Get out, take what capital you have left, move on to something else if it's not doing what you need it to do. But you're still bullish on it. What I like to do on it is depending on when I buy the options, if let's say I'm looking to do a 3-month trade, I'll buy a 3-month option on it. Let's say I'm long the stock, long the put, and I would let it sit there for probably 60 days. Usually when time decay starts to work against you the most is the last 30 days. And so if I'm buying a 90-day option on it, I would usually wait till about 30 days left before I start to look at it and say, well, I need to start rolling this out. Now, of course, that can all change if there's a movement in volatility, if there's news on the stock or whatever the case may be. But I would say a very, very, very general rule of thumb is don't let yourself be long a front month option unless you're doing some type of a spread against it of some sort. Because if you're long a front month option that's a married put, I think you're asking for trouble, quite frankly. Now let's do the third scenario. What if the stock goes down? This is where this strategy can get kind of fun. And I haven't been able to do this in a couple of years. Actually, I shouldn't say, probably about a year ago I got to do it. Was most recently. We had a collar going on IBB, and I was able to do what I'm about to describe. So let's say that you're long the stock at 75 and you're long a put option at 70, and the stock goes down to 74.50. Holy cow, I made some money on this put. I'm just going to get out of this put, and yeah, I made at least some money on it. So instead of being down 50 cents on the stock alone, I at least made 12 cents on the put. Well, don't do that unless you're really looking to love your broker, as we say in the odd block. With that, there comes a point to where I think you need to do stuff. If you're just long a stock and long a married put, usually what I like to do is get it to the point to where, let's say I have 1,000 shares of something, and I get it to the point to where the profit on the put can buy me another 100 shares or 10%. So let's say I'm long 100 shares and I'm long a one put option. I want to get to the point to where, let's say it's the $75 stock. As soon as that put would be profitable by, and let's say they have 100 shares of it, so $7,500. As soon as that put is profitable by $7.50, I would actually take the profit and then buy another 10 shares of stock. And by doing that, this is one of my all-time favorite things to do. If you're a longer-term investor, this is what I like to do with dollar cost averaging and letting the market pay for it. You know, the concept of dollar cost averaging, you put $100 a month into your 401k every month, market goes up, you're happy because your current shares are higher, market goes down, you're able to buy more shares. It's the concept of dollar cost averaging that's pitched by almost every financial advisor on the planet. You get to a point where you have a nest egg and you don't have more money coming in, and you want to be able to buy more shares when the market's lower, but you still want to have exposure to the market. This is kind of my solution to it for a lot of my clients, is that if the market's lower, use the protective put to buy more shares, the profits on the protective put. Then market goes higher, your break-even point is much lower because of the fact that you dollar cost average down. And the most fun part of it, just to quote Tigger, but the most wonderful part of it all is that you actually have the possibility to be ahead even when the market's lower. It's a long-term holding, and it's a situation to where, you know, if you like the stock at 75, you're going to love it at 65 if it's that type of a stock, which if it's not that type of a stock, the strategy isn't very good for you, I don't think. Then I think that can be very exciting. And at that point, let's say that you have maybe 100 of those 100 shares that you just let the market pay for. Maybe add a 1-by-2 ratio spread to them so you can get double leverage on that without taking on any more risk. And what that then does is that if the market then goes higher, that pays for the extra cost. That ratio spread could potentially pay for the extra cost of setting up that put again. So hopefully that explains it. A lot of times when I do this, it is with other strategies, with covered calls, call spreads, or ratios, or things like that. But that was fairly basic of where I like to go with things when rolling puts in one way, shape, or form.
I like it, sir. Well done. On the fly strategy block. There you go, listeners. Ask and you shall receive. Next time I'm going to have to gin up the language a little bit, see if I can get you guys to vote for some paying for protective puts. Since we're talking about what you guys are voting for, let's do real quick. Let's pay off this week's question of the week. We asked you guys, first it was Harvey. First it was Harvey over there in Houston, and then of course Irma going up the coast of Florida. Now we have Jose doing some weird backflips out there in the Atlantic. It has a lot of people have disaster prep on their mind. You prep your house, prep your car, probably your family, check your insurance. How do you prep your portfolio for disasters? We asked you. We gave you a few options, pun intended. We asked you, do you want to get long some vol? It could be VIX, could be VXX, UVXY. Pick your poison. Just getting long some vol. Vol products, that is, not just vol in general options. Or do you want to go to cash or T-bills? Or do you want to maybe stay long, but buy some index or some stock puts if you're on single names? Or you want to go to the quote-unquote risk assets like your golds and what have you. So there you go. Let's start. Uncle Mike probably needs a bit of a break. So Mr. Rocklops, we'll start with you. What is your vote, and what do you think is winning?
I think my vote was still VIX, but I think the risk assets I think just buying index puts are what people like. That's what I'm saying. I'm going VIX. They're going puts.
Interesting. Mr. Uncle Mike, you've had a few more days to think about it. What feel you, sir?
I like index puts and the metals, but it's tough for me to decide. So, you know what? I think I went index. I think I went metals earlier in the week, but I'm going to change my vote to index puts, and I think the audience actually went with VIX.
Interesting. Yeah, you did go metals. The audience is going with VIX, about 30% saying getting long some VIX, VXX, or UVXY. 27% coming in number 2 saying they want themselves some risky assets like gold or others. Or I should say risk asset, not quite so risky, even though they have their moments. And then close, though, 26%, 1% behind, saying buying themselves some puts either in the index or in your individual names. Only 17% going to go hide in some cash or in some T-bills. Interesting stuff. You got about another day, actually a couple days left to vote in that one. If you haven't, add options, make your voice heard. Meanwhile, let's keep on rolling. It's time for our final segment. It is time for Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody, welcome to Around the Block. Like the man said, this is the portion of the show where we break down what the heck we're watching for the rest of this week into the weekend. A little bit of DC, a little bit of hurricanes, a little bit of maybe, who knows what we're watching. Let's find out right now. Let's go in reverse order. Let's go back to the Rock Lobster. Mr. Rock Lobster, what you watching for the rest of this week until weekend, sir?
I literally, I am watching Tesla just because it's like, you know what it is? It's like the person you are watching and they're going to run into a glass door, but you have to watch because you can't help it, and they're going to bounce off the glass, hopefully, and not go through it. And you're like, so that's what I think Tesla is kind of. It is an interesting stock. I shouldn't say never, because Amazon seems to defy gravity as well, but that's what it is. Future premium, the September future premium is really massive. October is large. That actually bodes poorly for the vol products. But you'll hear about that when you ask us what's going on. But those are really the two big things, and I think Washington still, to some degree, is calling the volatility shots.
Mr. Uncle Mike, do you concur? Is Washington calling the shots, or is Jose calling the shots, or is some crazy guy in North Korea calling the shots, or who's calling the shots, sir?
I don't know. Twitter's calling the shots, I guess. I don't know. Yeah, there's a lot of things that, like Andrew had said, 2,500, of course, is my main focus, as it was on Monday. But I agree with what Andrew said with a lot of the macro events. On the coming weeks, once again, I will be watching the healthcare sector for reasons I discussed earlier. And the other thing that I'm watching going into this weekend, or on this weekend, is the Buffalo Bills, who have the best record in the NFL right now, taking on the Carolina Panthers.
I always got to throw in your plug for your beloved Bills there. We shall see. We shall see how they do. Meanwhile, speaking of seeing things, let's see what everybody has up to. If I can get my music There it is. Need my music to wrap up the show, otherwise it's just not quite complete. Of course, that tune means we come to the end of another epic journey through the world of options. A little bit of fun at the top of the show, a lot of fun at the top of the show, talking about earnings, talking about crazy Mr. Rock Lobster's love for all things VIX, iron, condors, and all kinds of nonsense. Uncle Mike still selling his XLE 30 puts. All sorts of fun. Got into some interesting reviews there in the odd block as well. Looking back a little bit, you guys are always asking us, how does this trade do? How'd that trade do? So we did just that. And we found out that pretty much 2 out of 3 didn't do so hot. And the third one, it did all right, but it probably wasn't the best trade to do either. So maybe 0 for 3 on those. We'll see. I mean, you factor in margin and cost of carry and everything. That trade not looking so hot. So there you go. One a poop sandwich, one like a poop fajita, one like maybe a tiny little sampler of poop. Or gelato, your choice. And of course, let's wrap it up. Let's go. Oh, Uncle Mike, of course, holding the court. Epic random off the top of his head of hedging. Excuse me. Yeah, not how to pay for your puts. It was rolling your puts. Good stuff there as well. But before we go, one more time around the horn. Mr. Rock Lobster, in addition to your forthcoming 10% OTM VIX Iron Condor Fund, what else you guys up to over there in the pit?
We are doing our Saturday classes tonight on a Thursday, just because we're going to be gone on Saturday. About directional trading using volatility, helping you price those positions. So yeah, there's a little bit of room left, so surf on over to the event page. Also, I am going to be doing a 4-part class on the VIX. I'm calling it the Easy VIX, breaking down all of the strangeness of the product so you totally understand how to trade it. It'll be a 4-part class, probably for under $100. That is coming out in October. So anyway, if you don't know how to trade the VIX or it confuse you, this class will, and there will be a trade every session. If you can't pay for the class, with the class, I will be massively surprised, because I think my clients and all of our vol classes have paid for all their classes easily with our stuff. So, hey, it'll be a soup to nuts, and you'll actually understand how the VIX works when you walk out of it. And I guarantee you, if you don't know how it works right now, it will pull the curtain down and you will see what the deal is.
Good stuff, 4-parters. And if you ever said to yourself, I like a Saturday webinar, but I like that I have my Saturday webinars on a Thursday, Option Pit got you covered. Thursday, Saturday webinar series. That's not confusing. Check it out, optionpit.com. to learn more. And Uncle Mike, what say you over there if perhaps someone comes to you and says, I'm tired of these ticket charges, or perhaps I would like to attend that webinar that the Rock Lobster mentioned, but I don't have the cash quite yet. What would you say to that person?
Well, first thing, to be honest, if you don't have $100, then you probably shouldn't be trading the VIX, quite frankly.
That's true. That's true. They probably shouldn't be talking to you.
I would say this. We offer a variety of things at RCM. The thing that I want to pitch today or talk to you about today is you may have a large single stock position. Maybe you bought Apple at $20 a share. Who knows? And you just can't sell it because of the fact that taxes are killing you, whether it's Apple, Amazon, Google, whatever the case may be. Give us a call. We can talk to you about ways with which we hedge it through our option strategies. I'm more than happy to go through tax implications and things along those lines. And not tax advice, but just say, if you sell it, this is what you will pay and that type of thing. So feel free to contact me on that. And for any of our services, if you become a new client starting today, or actually it was from we've been doing this for a while now with a lot of happy people, that $100, I will pay for it because I will give out a $100 Option Pit gift card for any new client. So if you are interested in such a thing, or you have a large single stock position that you want help hedging or selling calls against, whatever the case may be for your individual situation, give me a call at 312-212-3531 or shoot me an email at mtosaw@rcmfs.com.
Hit the man up, and if you go head out there to St. Charles, you want to see the man in person, I bet you he'll sit down. He'll even spring for some delicious Skippies, gyros, and lemonade. Hit him up if you're out there. It's a good place. It's fun. All right, and on behalf of Uncle Mike and the Rock Lobster, who I believe, Mr. Rock Lobster, are you attending the big shindig next Thursday?
Is that, the Mike's? No, I am not going to be.
No, the Option Pit thing. Next Thursday. You going to be there?
No, I got to mind the show while Mark is,
Oh, that's not. I was going to see the Rock. I was going to tease you could see the Rock Lobster. Okay, no Rock Lobster, but you could see me You can probably see Uncle Mike. Maybe if you want to, the Greasy Meatball. Who knows who else there. Fun stuff. Their big extravaganza next Thursday. Come see us if you're in town. It should be fun. In fact, we'll be doing the show there next Thursday. So this time next week, we'll be doing that. It'll be fun. And on behalf of Uncle Mike and the Rock Lobster and the D myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, all the fun stuff you do, including hitting us up with such great questions. Keep them coming. And we'll see you next Monday for more of the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.